It was a very popular video. You were speaking about a 40% correction in the stock market by April. I've now seen you've shifted that timeline to June. So before we really get into the nitty gritty here, Harry, I want to give you the platform and the opportunity to explain why the change in timeline now.
Okay, I mean, we're at a point, the truth is, by my most fundamental cycles, which are really, really good long-term, it took me 20 years to really put them together correctly and the hierarchy and everything. We should have peaked back around COVID, okay? But COVID hit and it gave governments our gargantuan open to just open this big, it's 100%. I mean, we've never seen, I've counted now fiscal and monetary since just before COVID and the repo crisis and since year and a half, 55% of GDP, about to maybe go to 65%. This is the biggest stimulus in the whole Great Depression was 6% of GDP, okay, at the bottom. So that's what happened here. And then so we're looking, the markets you have diminishing returns from this sort of stuff, okay? I mean, how many times has everybody refinanced their home at a slightly lower rate or traded up to a little better house or whatever, or sent your kids to a better school or bribed the principal, whatever you had to do, you know, there's the limit to how much people can spend because the baby boom is still the major force in spending and they're aging and then they spend less as they age. So we got a market that just keeps getting propped up by gargantuan stimulus, but it's still showing signs of topping patterns. So there isn't like a perfect timeline here at this point, Danielle. It's just that simple. It should have been over at COVID, bounce, never made a new high. And now we're at new highs, even though the economy's not back close, which is a big disconnect.
Okay.
But I'm just reading chart patterns at this point. And it looks like at this point, we could see one more leg up still. Not a lot. Maybe we go to 44, 4,500, a little higher. Maybe I got one chart that says we could go to 4,700 on the S&P in the next month or so, and then we top. Because it is very clear that no matter what happens, they're just going to print more money and now fiscal stimulus. And the fiscal stimulus is more powerful, by the way. It's also the reason the small caps did better in this last year, because the fiscal stimulus goes more to real companies and small caps. And I don't mean tiny, I mean small cap, billion-dollar companies instead of multinationals. When you do monetary stimulus, it just throws more money in the whole financial pot, and it makes the biggest stocks and then leading stock indices like the NASDAQ and the S&P go up the most. So that's what we're dealing with. Small caps are doing better. NASDAQ is the one that's weak now. We're still in a topping pattern, and it still looks close to me. I'd say early June for a top would be my best target, but it is a moving target. I mean, I lost control over short-term stuff a long time ago. We were warning in late 2019 that by early 2020, we should have a major crash. Well, COVID was the perfect trigger, and you could have blamed it on that, but it was set to go down anyway. But COVID did give the ultimate, okay, now governments can do anything to save the economy because COVID is an outside threat, like the Jedi are getting attacked or something. So, and that's very...
Last time you were talking about a 40% correction. Are you still sticking to that type of percentage, let's say in June?
Okay. Yeah, let's say it starts in early June. That would put it maybe bottoming in August. Okay. This is coming from what I call a megaphone pattern. Ever since January 2008, when the first real bubble hit headwinds and peaked, we've been going more sideways ever since. Slightly higher highs, but the lows have been more significantly below. We're in that final phase of the megaphone where if it breaks 4,000, then you start to get in that danger zone. And the first target down is 2,100. That is now a 50% crash. So that bottom line target through the lows in this megaphone has not changed. It's still 2,100, give or take. So we go there from 42 or 4,400, then it's 50% plus. My original targets were a little lower, and that's what made it 48, 49%. So that's the one thing that's pretty clear. If we have a significant break, this will be as big a first crash. Now, this is not unusual if you look at major bubbles. The first crash in the 1929 peak, even though it went down to 89% in the end, was 49% in 2.3 months. That was when it said, it's over. And you know what the problem with that? People say, well, wait, I don't want to get, what's going on? Okay, you want that last 5 or 10%? Or are you going to be that fast to miss 49% crash in 2.3 months? Or are you going to be one of the millions and millions of people that will panic at 50%, think it's going to 90, and then it'll bounce halfway back and you'll feel like the biggest idiot on it? So it's very tricky here. It is better to be on the safe side and at least have a quick trigger. If this thing breaks 4,000, warning. 3,800, another. 3,600, okay. Better be decisive, because that is what it's saying. 50% in 2 months minimum, 4 months maximum. That's a big crash.
Why such a harsh downturn?
Because you blow up the bubble. Does the bubble just go pop? This is keep blowing it up until it pops. This is not, oh, blow it up and let a air out. It's going to burst. That's what happens. I went back 100 years, 7 bubbles, including the Nikkei. The average first crash was 42% in 2.6 months. This is how bubbles pop. No exceptions in history. If this is the first time because of stimulus, then fine. I'm not betting on that or telling people to bet on that. Because I remember I was in Dubai, one of my seminal moments, I'm talking to Dubai right before their big real estate bubble burst in 2008. I was there in late 2007. To talk about a place that was stimulating, government building everything, supporting everything. People said, Harry, it can't go down here. The government won't let it. 50% drop in real estate in the next year, a bigger crash than we have ever seen in 1 year, ever, twice as big as we've ever seen in 1 year. Happened the next year because the bubble just burst and then burst so uncontrollably. Because what my response when the audience said that, I said, well, if you're telling me it can't burst because the government's supporting won't let it go down, then I'm more bearish. Because that means they've blown it up more out of whack. Natural bubbles burst, government bubbles get stretched even farther. So there's nothing unusual if you study bubbles for a major bubble to burst 45 to 50% in a matter of 2 to 3 months. That's exactly what you should expect. We just haven't seen it do that yet.
Once it bursts, how long does the depression last, Harry?
Okay, depressions take at least 2 years and usually closer to 3. The Great Depression was 34 months, so that's 2 months short of 3 years. I think this one could be I think this one will be more dramatic because it's been stretched. I think when it finally blows, it'll blow harder and a little faster. So let's say we were to peak now in, let's say, early June, maybe a month from now, okay? And we have this first crack. Well, it's going to bounce after that. It'll take half of that back, and then it'll go down more steadily for a couple of years. I'd say the earliest time for a bottom is the end of 2022, and the latest time would be the end of 2023. So, and the economy, the stocks will bottom. I'm talking for stocks. If stocks bottom in late 2022, the economy's not going to come out of it until at least mid-2023. So you've got like 2 more years of volatility in the economy stuff, minimum, and it could be longer. So again, I'm going to have to judge that as it goes. But the 29 crash, which is the most comparable to this, took 34 months for stocks to bottom. And then after stocks bottom, it took another 7 years, right when FDR walked in the office. Luckiest man, president, in all of history times 2. Walked in on the day almost that the economy bottomed and turned up straight up for years and years. He'd have been sleep drunk and probably a little bit of both there too. He would have still been a popular president. He also did some good things, but that's when you want to walk in president.